Welcome back to M&A Plus, the art after the deal, where we look into the strategies, challenges, and accomplishments that define successful mergers and acquisitions. Today, I'm thrilled to be joined by Keith Crawford, the Global Head of Corporate Development at State Street, one of the most respected names in financial services. Keith is a seasoned leader who has navigated some of the industry's most complex and high-value deals, including carve-out acquisitions worth billions of dollars. With his wealth of experience, including a tenure as CFO, Keith brings a unique perspective to the art of strategic M&A. In this episode, we'll explore Keith's approach to tackling the challenges of carve-out acquisitions, his philosophy on integration and cultural alignment, and his insights on emerging trends in financial services and fintech. Whether you're an M&A professional, a corporate leader, or just curious about what happens behind the scenes of transformative deals, this is an episode you won't want to miss. So let's get started. And thank you very much for joining us today, Keith.
Good afternoon.
Good afternoon. So first, Keith, to get us kicked off here, you've had an awesome career in the financial services space, long career. Can you share a little bit about your journey to becoming the head of M&A and corporate development at State Street?
Sure, absolutely. Thanks for having me. And I'd like to say that, I started off in my career as an accountant. I don't know particularly why, other than I figured I could get a job quickly in the accounting environment. I grew up in a household where my father worked for a union and he went on strike occasionally. So I gravitated to that field. My mother was a bookkeeper, so went to school and got an accounting degree. I think it was confirmed when I had a upperclassman at university tell me he got a job at Goldman Sachs, and then he came back a couple months later and was complaining because Goldman told him, you have to go take more accounting courses till you join us. So felt I made the right choice, jumped out, got my letters, worked for a public accounting firm in Hartford, Connecticut, and then got the bug to travel. And I went and worked for a publicly traded company at the time who had offshore operations, 60% in Europe. So I got to travel and worked in their internal audit group. Then I migrated up to E&Y and worked for their transaction advisory services practice for about 3.5 years, traveled excessively, saw a lot of businesses in different industries. And the travel did get to me after a while, walking into an office thinking you're going to work in the office all day and they tell you to go home and pack your bags. I think it's exciting at first, but after a while, the unpredictability really did impact my lifestyle. But it was an incredible experience and happy to get a position at State Street in their M&A group. And that's where it began.
Great. And how long have you been at State Street?
I've been at State Street a little over 20 years.
20 years. Okay, good. And I know that you spent a little bit time being the CFO there. So I wanted to ask you kind of what area do you prefer, being the CFO or doing the corporate development role?
Yeah, I think it's probably even. And I think before I jumped into the CFO role back in 2013, I did a couple transactions for the CEO of SSGA. He had asked me to come over and be his CFO. I was a little nervous at the time because to be a corporate development person, you have to have a little bit more of a project-oriented skill set. You have to be unstructured in a way, and where you're going into a quarterly earnings cycle, quarterly forecasting, monthly forecasting. I did get a little nervous about the structure being too constrictive to me, but I did find it to be especially rewarding in the sense that whereas in corporate development, you work on the project, you bring it to the integration stage, and then you go to the next project. Whereas in the CFO role, you actually get to bring projects to completion and see them develop and actually see them succeed or fail. Most of them hopefully succeed, and they did in my case. But I think that was another resounding thing. And then working with a consistent team that's qualified at the same time. You're working with, a good set of a COO, a CIO, a president, and a CEO and head of legal as well in the CFO role. Whereas in the corporate development role, you meet a lot of different people depending on which area you're looking at, an acquisition or a divestiture.
So how do you think your role as being the CFO impacted your approach to the M&A role?
Yeah, I think what it did is it gave me a little bit more perspective about the out years. I think When you do corporate development, it's the infamous proverbial hockey stick when you look at a confidential information memorandum where, most companies, they project a linear growth going forward, whereas you become a CFO, you realize the linear growth is less likely. So it allowed me to, when I came back into corporate development, put a little bit of a different lens on it in terms of what the out years would look like and how you could actually achieve the out years.
Mm-hmm. Okay, good. That's interesting. So let's move on to some of the deals that you've done. So could you give us a little flavor of what types of acquisitions that you've been involved in, the sizes, and kind of what industries they were?
Sure. So State Street, by virtue, one of the world's largest global custodians, we're sort of a bank for banks. We move a considerable amount of assets and money on a daily basis across the world. We also do have an asset manager in our portfolio, which is a beta index passive manager. We don't really do active. We do manage money market funds, but we're institutional. We do not touch the retail area or a retail client. You can't go to State Street and withdraw money out of an ATM, but certainly the world's largest institutions, official institutions, central banks, they're our clients. And so I'd say from an acquisition perspective, we're looking for more geographic expansion and capability expansion, and product expansion does come into play at times. But I would say the financial services space, particularly in the banking world, it's hard to have disruptors in there other than in technology, which I think we're going to talk about a little bit later. But I think it's a very highly regulated, very important space. And I think in terms of where we want to go, we're looking at things that will help enhance our service offering to our underlying clients. And types of transactions that we look at are other types of custody, fund administration, fund accounting capabilities in growing countries. We hope that we're investing in countries that are going to be growing on a long-term scale. And then on the asset management side, we do look at product set. We look at product set in terms of additional capabilities that we can bring to our larger clients in terms of what they need to utilize in their asset allocation portfolios and the like. So, and then as of recent, it's not recent, but it was about 5 years ago, we did the Charles River acquisition, which moved State Street into the front office, which was a new step for us. That really brought us into the fintech world. So that one was new. That took a lot of, education, a lot of market study, a lot of industry analysis for us to figure out where it goes. But it actually was a nice progression of our service offering to clients. And so that's a fintech space. I would tell you the banking space is much more standard, much more uniform, and even in the asset management space as well. But when you get into the fintech world, it's a pretty open and pretty diverse area.
Yeah, I can imagine. So I was reading about State Street, and it said that you guys are managing trillions of assets for around the world. So that's huge. Yeah. So I do want to talk more about the technology pretty soon. But first, I wanted to kind of focus a little bit on the Carve-Out acquisition scenario. So I'm involved in a lot of Carve-Outs and spin-offs, and I know that there's some complexities that exist with those types of acquisitions as opposed to just, buying a startup, company full. So I would like to hear a little bit about, your views on Carve-Out acquisitions. What's been particularly challenging in those Carve-Outs, and maybe your views on how you've approached that type of acquisition?
Sure, it's a good question. So the majority part of our business, as I indicated, is the custodial, fund administration, fund accounting. That's the core business that we have. If you look in the marketplace around the globe, most of those businesses are not standalone. There's several, but I would say they're in the minority area. But they're mostly part of another banking component, and they're not set up as a separate subsidiary, separate entity, separate bank. You don't want to have multiple banks. So if you go to the universal banks, particularly in Europe, the universal banks want one banking license. So they do a whole suite of services under one banking license. But if they want to sell off their custody and fund administration business, which we call security services, that involves a carve-out. And that's something that over my career here, we've done numerous carve-outs. And I would say not one carve-out is similar to the other. They're close. Some can be close, but there are unique circumstances depending on market requirements, local country requirements, and how the universal bank or the bank itself has developed in terms of servicing their clients. So
Mm-hmm.
I would say, in terms of looking at carve-outs, it's a very operationally intensive and
Mm-hmm.
focused acquisition. The requirements are tedious. That you need to make sure you know what you're acquiring. And as I said, there's no one carve-out like the other one. So you've
Mm-hmm.
got to set your perimeter. You've got to
Mm-hmm.
set the perimeter and understand what's in scope and what's not in scope.
Mm-hmm.
And even after you do that, you have to determine whether, when you bring that onto our platform and we scale our platform, are we performing services or required to perform services for the
Mm-hmm.
clients that we inherit in that acquisition that we're not performing elsewhere in State Street? And that's something that we have to constantly ask ourselves and determine. And it requires a negotiation, sometimes discussions where we ask the seller itself to actually back those components out
Mm-hmm.
if they are services that we just don't think are feasible or in parallel to what we do, and they're not customary. So sometimes the seller will take them back, sometimes they won't, and we'll have to find another provider. There's certain solutions that you have to do. So
Mm-hmm.
they're very bespoke. Carve-outs are very bespoke. We do have a really successful playbook in terms of how we do it, but you've got to leave a little bit of agility in there for the underlying profile of the opportunity that you're looking for.
Mm-hmm. So that leads me to a question specifically about contracts management. So that's my area. So I know that you've done a lot of successful carve-outs, and I'd like to hear your views on how you guys have managed the contracts through those separations and kind of what your approach has been. I know every deal is different, but I'd be curious to hear how you've managed, procurement and customer contracts through those carve-outs.
Yeah, and so they're critical, right? The contracts are absolutely critical in terms of memorializing the transaction, not just to get to the signing and ultimately the closing, but what happens post the transaction. We have a very good M&A team from a legal perspective that we work with repetitively on transactions. It's a core team. We have tax folks, IT folks, individuals that are very versed in this area. We
Mm-hmm.
do hire some of the world's top, legal firms to help us with the contractual and the development of the documentation and the like. But we do have a standard sort of set of documents that we require. In most transactions that we have, we are actually acquiring a captive in terms of the universal bank is selling this service, but they also have an asset manager. They also have a large asset manager on their side that they're servicing that will come along in the transaction with us.
Mm-hmm.
And in those instances, we need to negotiate a separate agreement with that asset manager to make sure that we're paying the parent company for their underlying asset, but at the same time, we want to make sure that the revenue streams will continue post the closing for a very long time. So
Mm-hmm.
contractually, there's a lot of creativity that we have in terms of ensuring that the revenue continues. We can actually incentivize the seller to make sure that happens through various forms, which is earnouts, clawbacks
Mm-hmm.
that we actually assess, and certain targets that require post-transaction to make sure that, it's hitting what our IRR is and what our underlying valuation is.
Mm-hmm. So you kind of answered this a little bit, but I'd like to hear a little bit more detail about what factors are most important when deciding whether a deal is worth pursuing.
Sure. There's a couple things there, which is obviously the price. And that comes, that's the overarching in the corporate development world. But I would also say, we look at transactions, we probably have a couple filters or a couple lenses that we put on. One is strategic. Is it strategic? Is it really compelling to our platform? It could either be to our underlying core business, or it could be actually an adjacency strategy that we're looking to do at State Street.
Mm-hmm.
And when I say that, it's not, moving into a whole different industry. It's more maybe a different segment and a different client area or geographic area. The other aspect that I would say is what's the growth factor of the underlying opportunity? Is the growth factor attractive? We don't want to buy into an area, a country, a region that absolutely, has low growth profile
Mm-hmm.
to it. We need to develop a high growing business. Our shareholders expect that as well. So the growth factor of the underlying business as well, and then what's the expected return, and that's a couple of things. That's, can we scale it on our current platform? Are there synergies that we can bring to this? Are there other capabilities that we can bring to clients in terms of product set capabilities, product services, and the like? So we definitely have to factor that in, and that all goes into the corporate development analysis that we utilize, that we end up bringing to the senior management team to support and decide on whether we want to go through with the transaction.
Right. So have you experienced a failed acquisition, or what you would consider a failed acquisition? And can you tell us a little bit about that
So
experience?
when you say failed, did it not get there, or did we acquire it and it didn't perform to our standards?
I was thinking the latter scenario,
Sure. Yeah,
but
I
I'd
did
like
it.
to hear your definition on, like, what would you consider, as a failed transaction as well?
Yeah, I have an example. It was relatively small, thankfully, but it was a learning experience in the sense that we acquired a capability that was in the performance analytic area, and it was a small transaction, but it had a lot of upside that was associated with it. I had gone through and executed the transaction and assisted in the integration, getting to the closing, and then supported just a little bit on the post closing integration. But then went away for 2.5 years, and then was contacted again in terms of, well, we don't think this is strategic to our portfolio. And I was kind of questioning. I had to
Mm.
go back to the old valuation and strategic plans and assess as to why that was the case. Well, what we found out is that we have a lot of mobility at State Street, which is a great thing. And we happen to have a turnover, and the individual who actually spearheaded that transaction and was the sponsor of that transaction moved on to a new role.
Mhm.
And effectively there wasn't a proper handoff, and so the vision sort of got lost. I mean, we're a large global company, so the vision got lost. So I'd say that was one that was disappointing, because maybe it was just structurally post transaction how you
Mhm.
could work it. And so what we've done since is we've had learnings on it, and we make sure that there's continuity
Mhm.
despite the fact that management's there. We're constantly revisiting the strategic underlying sense. We review our business probably a bit more diligent in terms of acquisitions that come through, to
Mhm.
ensure that they're being developed and they're being analyzed and reviewed, to ensure that they're
Mhm.
being held against the original standard of what the valuation of
Right.
the projections of the original deal formulated.
Yeah. Yeah, that made me think about, the due diligence process. Sometimes it's rushed. Do you find that having there's pressure to get things done, and how do you balance, I guess, the thoroughness that's needed to make sure it's a good purchase versus the pressure to actually do the deal?
Yeah, and so that it is a balance. It's a unique balance, and it probably varies by transaction. So I absolutely agree. So about 5 years ago, the CRD deal that I had mentioned, that was a different deal. It's something that we didn't have in our playbook exactly, and we did source a lot of third party consultants out there to get a better view as to the underlying business to do it. You never really know, and we kept digging. So we just kept digging until we got to that point where we felt comfortable.
Mhm.
Unfortunately, we had a seller that was, open to allowing us to get to that comfort level. But I agree with you. There are some transactions where you need to move quicker if they're competitively, driven. And so you've got to make an educated guess as to where you go, but you do everything that you can at that point to maybe like ring fence the parameters and ring
Mhm.
fence the risks in terms of where you are. So it is a balance, but I will tell you, post COVID, most transactions have taken maybe a downshift in terms of what the speed is.
Mm.
I think buyers are very, very astute these days. And I think sellers want to know that they're going to get the right thing done. And they know if they rush it, they may not get the right outcome. So
Mhm.
I'm finding that transactions these days are a little bit slower, maybe a little bit more deep dive and formulated than transactions that took pre-COVID.
Yeah, I agree. I noticed that too. I guess it was 2021, 2022 was crazy. There there was all kinds of purchases going on, and it was literally crazy, and did slow down a lot this last
Yeah.
year.
Yeah.
Could be more cautious. I mean, I kind of feel like there's a little more caution in what people are spending money on, basically, in general.
Yeah, and I also think we're at top of the market in terms of interest rates. There's a lot of PE funds out there that have legacy assets in their portfolios, and their funds are
Mhm.
actually, I think they're beyond their target of when they thought they would actually be realizing returns. And so I think that has to do with interest rates as well in terms of where we are on the interest rate curve. And so I think hopefully it plays out well and starts to unleash some of this value back
Mhm.
into the marketplace.
Yeah. So let's move to the integration topic. So we've talked a little bit about it already. I often say that integrators are the heroes of the M&A world. I don't know if you agree with that, but do you agree? And what is your philosophy on integration planning and execution?
Yeah, so I absolutely agree. Even though maybe I'm not directly always involved or related to it, it's absolutely critical. I can negotiate the greatest deal ever, the greatest protections, the greatest reps warranties, along with my lawyers. But when the transaction closes, if we don't realize what we put on paper for projections and what the art of possible would be with the underlying business and the synergies don't transform, I do believe that is critical, and that's on the backs of the people who are going through and doing the integration and building out that plan that we put together when we did the original valuation and
Mhm.
estimate on the transaction. So I think absolutely critical. They are the ones that will ensure that we do realize what was projected, and they're part of the process up front as well. So it's not like we're just handing it off to them
Mhm.
and showing them something that they didn't see previously. So I agree. I agree. Integration is critical
Mhm.
because if you can't realize the return, then you failed at the transaction.
Yeah. So it sounds like you said that the integration team should be involved early on. So what other things in the process before the deal closes do you take? What steps do you take to make sure the integration process begins before the deal closes?
Yeah, sure. So, I mean, we make sure that we, from a structural perspective, we have a business sponsor, a business leader, and underneath that business sponsor, there is the integration team. I mean, we are a global organization. We have over 40,000 employees globally, but a lot of people wear different hats in our organization. So if you're in an operational area or a sales area and the like, you'll be actively involved in the upfront assessment and
Mhm.
diligence of the transaction to pressure test and see whether that the synergies are right, whether the integration can occur over the right period of time and effectively at the cost that we and that we assess for the underlying synergies to be achieved. So they're involved. The deal team, the extended deal team includes all those representative functional areas that are required to bring through and carry through the execution of that ultimate valuation and business plan that's going forward. So
Mhm.
yeah, heavily involved in that. They're the ones, and we have experienced individuals throughout the organization that have been successful, on multiple transactions, and
Mhm.
that's helpful in terms of them understanding the full life cycle of how this comes through.
Can you tell us a little bit about an unexpected challenge that you faced during integration and how you resolved it?
Yeah, I don't really particularly have anything from an operational perspective, but
Mhm.
it's more from a contracting service perspective. If you could think about it, even though we're acquiring an asset or acquiring a business, a lot of the underlying aspects of that business that you're acquiring, they rely on third-party vendors. They rely on
Mhm.
third-party software platforms, software providers to actually service their clients. So in many instances, when we acquire that business, say it's in another country globally somewhere, and we don't have that capability, we're going to depend on that vendor. So
Right.
it's really hard from a
Mhm.
confidential perspective to go and negotiate with that vendor beforehand. And so in many instances, you'll find, we try to tell the seller that, we're assuming that effectively any contract they have on a commercial basis with any third party provider would be at relatively the same price once we come in. But if we have to renegotiate the contract and it's up 20% or 30%, that's not helpful from our valuation perspective. So I would
Mhm.
say there have been several instances where we've had third party vendors who've come in
Mhm.
and said, oh, we've got big, State Street, big pockets, we're going to actually try to negotiate a much better transaction or much better deal, commercial agreement with them as opposed with the previous owner.
Mhm. I
And
see.
so that creates a bit of tension, I think. And
Right.
those are the areas that I get actively involved with. They're difficult to do. You try to do it, but like I said, you're stuck with the confidentiality. You can't go out and announce transaction.
Hmm.
But at the same time, you don't want to give the vendor that much time to think about it, because then they start to get creative.
Right. So how do you resolve that?
It's really through a tripartite type of a discussion. You've got to, in the contracting, you've got to make it a little bit painful for the seller if we can't conclude on certain terms with that vendor,
Mm-hmm.
and the seller's on board for it. So it's a little bit of a coercion process, but we ultimately get there, but it's not always as smooth as you'd like it to be.
Yeah, it sounds like an art.
It somewhat is, but it's unique. It's unique to each situation. But yeah, I mean,
Hmm.
I do agree. And what we try to do, and it is a debate every time we introduce it, is we just try to tell the seller, like,
Hmm.
look, you're going to be partially responsible should the prices or should the contract
Hmm.
rate card be higher than what you're currently paying.
Hmm. Great. Yeah, that's interesting. So now I'd like to switch and talk a little bit about trends in M&A in the financial services space and also technology. So let's just do a general question first. So what trends do you see in M&A within the financial services and fintech industries, just kind of in general?
Let me talk about in two areas. In the banking space, I would say it's actually the same in both areas that we really play in. It's technology, right?
Mhm.
Technology is absolutely critical. We've seen disruption, I think, in both the banking space and in the fintech sort of front end office software space where we're playing. And even into some respects in the asset management space, you're seeing a lot more agile, capable, cloud, SaaS based capabilities that are coming to market that are actually disrupting legacy technology.
Mhm.
And I think, with the introduction, we're not quite there yet. I know we are in some of the processing stuff in State Street. We're
Mhm.
in there with data learning and AI and the like, but that's
Mhm.
more on sort of the heavy volume, heavy reconciliations items that we're doing. We're not using it. I don't think we're using it openly in a way in our M&A world and our analytical world, but technology is critical.
Mhm.
I think, and I point back to the robo advisors. When robo advisors came back out, I think around in the early teens, like in 2012, 2013, the way that I looked at it, and I was the CFO at SSGA at the time, was they built a much smoother, effective, sleeker front end platform that asset managers, I think, who are under investing in their wealth platforms or their asset management platforms, they built a very, very sleek front office. I mean, a front end interface that it's pretty compelling. And I think that was with the
Mhm.
development of technology that happened. But
Mhm.
what ended up happening is I think the wealth providers and the asset managers caught up eventually and either acquired those platforms and put them on their front end, or they
Mhm.
developed them internally knowing that they might be disrupted even more. So
Right.
technology, you have to keep on it. We invest incredibly in technology at State Street.
Mhm.
It's a big part of our annual budget. And so I think technology, you just have to be aware of it. The one benefit I loved about State Street and being at State Street is, I say this to certain individuals, I mentor for university students and MBA students. And I say to them, they ask me why I chose State Street. And I said, well, I think getting up, I worked through the dot-com boom when I was at Ernst & Young. I said to them, getting up in the morning and knowing that my business isn't going to be disintermediated, because banking is critical and safekeeping of assets is critical. And it's always going to be critical.
Mhm.
It may take a different shape or form, but I don't think it's going to be, it's not going to change overnight. And
Right.
so those are one of the things, but at the same time, you can't get complacent. You've got to actually continue to focus on where the market's going and ensure
Mhm.
that you're investing for the future.
Mhm.
On the fintech side, I'll tell you the prices are high in terms of what's out there. Software valuations are they're lofty. They're very lofty, and there's a reason for that, because if you look at the Apples out there, the Microsoft, and to some extent, Amazon with their cloud-based systems, they're doing very well, right? And I think it's an environment of few really successful winners, and there's just many more losers in that space. And the other part is there's, and I talked about it earlier, is the standardization or maybe the homogenization of the custody and fund administration space. But when you move into the software world, no two firms are alike. They were created for different reasons. And then they develop on paths that aren't really standard to each other as well. I mean, they're trying to find opportunity. They're trying to fit needs and demands in the marketplace. And you'll see in the fintech space, a lot of these firms have developed, capabilities that maybe they didn't even originate with those capabilities. So they're very quick, very agile, and those are the things that you got to look out for. And a lot of times when we look for our software business to expand, there are components, there are businesses out there. We really like certain parts of their business, but there's other parts of their business we just don't have any need or use for it. So that makes it difficult, I think, to acquire certain capabilities that are growing and developing in this space.
Yeah, I know there's been a lot of news about the blockchain lately and the potential for the blockchain to kind of take on a new, create like a new foundation for financial transactions, I guess the global transactions. I see a lot of, news, and it seems like it's a volatile space right now. But, from your vantage point, what do you see the blockchain doing to the financial world in general? Do you see it as substantially changing the way that we do financial transactions altogether?
Yeah. And we're all over it, as all the global banks as well. There's a lot of minority investments that we do in startup entities that are actually investing heavily in these types of technologies and capabilities. We want to be around it, as to the other global banks. I would say it's a bit of a push and a pull with respect to regulatorily where it goes. There's a lot of implications in going to digitization of currency. And I think it's exciting. There's, you turn CNBC on, you see it on the TV all the time. They're talking about, either crypto or digitization of assets. There's probably a bit of a distinction between those. There's a lot of hype there. I think at the end of the day, the banks will be very smart about it, and so will the regulators. But I think the implications are huge, as I said. You've got to think about things like common currency, common technology, protection of that technology, right? How do you safekeep it and the like? It needs to be assured and locked tight. So, and then the other aspect of that is who has access. I mean, I think there's been stories that have come out of China that have indicated that, certain, digitization or digital currencies are controlled. And so would the general Western population be comfortable with the fact that someone may have access all the way down to the penny of where they spent, how they spent it, and when they spent it almost instantaneously? I mean, that's conceivable if you go to a digital currency. So I think there's some degree of safekeeping and formality that needs to be rolled out in a way in which you have comfort and adoption of the ultimate digitization of that strategy. But I do agree, having dollar bills or euro bills and the like, it seems a little bit, I think, old school, and moving to something more digital based on where our technology is going and what everybody can do on their own phone and their own personal device is developing. I think that's going to have to catch up, but it's got to be done in a smart way.
Yeah, it's amazing the transitionary phase that we're living in right now, how quick things are moving and changing, and it could change very substantially.
Exactly. And the way State Street thinks about it is because we custody assets, actually physical, tangible assets, which includes, in most instances, currencies. And so the question is if we could do that in a digital way, that would take away a lot of the drag and demand and expense that would be required to hold things physically, particularly, we have a gold ETF. The gold is held in vaults. The ETF is backed by actual gold, and it's held in vaults. That's physical custody,
right?
And securities as well. We hold physical securities. So if that all can be digitized, I think it makes it makes things much more efficient from a certain perspective. But then you have other issues that you got to deal with. And that's, if you think about it, that's, I'm reading about it now, the dependency on the electrical grid and the power and that stuff that's required to actually transfer and maintain and keep these things moving.
Right. Yeah, that's a good point. So as we kind of get to the end of our podcast here, so I'd like to talk about, what advice you might give to M&A professionals and leaders around kind of the attributes and skills that you think are essential for success in M&A and corporate development, roles.
Yeah. Yeah. I get this question a lot. I think what I think about is there's a couple things. I'll go high and low. I think accounting, having an accounting, not being an accounting major, but having a strong understanding of accounting is critical. That drives the valuation, that drives the P&L. Most businesses, if you really want to understand, I know the financial health is the balance sheet, but also on the P&L and understand what the cash flows are, which everybody is seeking and they're seeking to grow and increase. So there's a lot of things that affect that projection. And if you have an accounting sense and a deep accounting knowledge, and I think it's really helpful in that type of situation. And then the other thing I try to tell people is to be, and anticipation is another word that I have. And the way that I say that is to be effective in this area. There's no two processes alike. I know I've said that a lot through through the podcast. But then there's no two processes that are alike, but there's similarities in all of them that weave through it in terms of the process. And so start thinking about, the younger analyst staff level, start thinking about the last transaction that you did, try to think at a high level, where are we going next? How are we going there? Don't stand there and wait for somebody to tell you what to do. So move ahead, be empowered. And that's another thing that I talk about is empowerment. It's a big word that I think many people misuse. Empowerment is just going ahead and doing what you think is the right thing. Now, it's not trying to go out and sell a business you don't have the authority to do or anything like that. But it's really taking that next step and not waiting for someone to tell you to do it and say, I've been through this before. This is how I'm going to do it. And that's where I actually think you're starting to create your worth and your know-how and your skill set, and you're developing as you go along. So those are the two things that I tend to pass on. And then the other thing is you need to be unstructured. You can't be structured. I know I talked about it earlier in the past. You can be both, but if you're not used to unstructured environments, it's just not the place for you. If you think you're going to drive into work or go into work that day and you got to definitively work on these three things, in many instances in this world, you walk in and for the next week, you're in a fire drill. You're trying to deal with something different. And you don't know what that fire drill, when it's going to end, or if you got to work through the night or whatever it may be. So it's the unstructured part. And that's what excites me a little bit is the unknown to some extent. And I think that's something that's critical for these individuals as well, to be in that space. And then the last thing I would say is you need to be able to go high and go low. You need to be able to understand the macro trends. You need to understand why something's happening. And then you need to be able to dig all the way down into the underlying assumptions and the details. So have that wide breadth in terms of that overview and that capability.
Yeah, that's great advice. I noticed there are certain personalities that are cut out for kind of that M&A environment, especially in the integration phases, and some personalities that they need so much structure that it's hard for them to be in those spaces. So maybe that's something to keep in mind if anyone's, thinking about going into those spaces, thinking about what your strengths are around that. The people that thrive in the M&A environment are typically those that thrive kind of in chaos situations and quick problem solving ability and things like that. So I totally agree with your advice. It's great.
On that point, the last thing I would say is you need to know how to accelerate and decelerate quickly.
Yeah, exactly.
You can't go at one speed. You'll burn yourself out. So when you're in a downtime or you're in between transactions or you have a little bit of a break in negotiations, take the downtime.
Right.
Don't think you're going to turn that into maintaining the same level on something else, because I think you'll burn yourself out quickly.
Yeah, that's important. Important point. So where can our audience connect with you if anybody wants to get in touch with you?
Sure, I'm on LinkedIn, and I believe my email's on the LinkedIn. Happy for anybody to reach out. I'm pretty responsive, not on LinkedIn always quickly, but I do eventually get through there. But I think that's the best way to meet me, because if you get into my personal email, my State Street email inbox, then I'll get buried.
Right. Okay, good. Well, thanks for being here. I really appreciate it. You've given us some great insights, behind the scenes insights, and I appreciate your time today.
Great. Thanks for having me.
So that's it for this episode of M&A Plus, The Art After the Deal. A huge thank you to Keith Crawford for sharing his experience and expertise and taking us behind the scenes of some of the most impactful M&A deals in financial services. From navigating the intricacies of carve-out acquisitions to emphasizing the importance of strategic alignment and integration, Keith reminded us that the success of a deal is built on more than just numbers. It's about people, planning, and purpose. If you found today's conversation valuable, don't forget to subscribe to the podcast, share this episode with your network, and leave us a review. You can find more episodes and resources at intoedge.com. Thank you for tuning in, and we'll see you next time on M&A Plus, The Art After the Deal.